Welcome to This Explainer. Today, we're unraveling what is honestly the ultimate financial mystery: how exactly the US dollar totally conquered the globe. Just think about it for a second. A simple piece of green paper. It buys your morning coffee in New York, fuels up cars in Saudi Arabia, and buys electronics in Japan. We are diving into the fascinating history of how this literal piece of paper became the absolute most powerful currency in human history.
Let's kick things off with this completely wild statistic. The United States makes up just about 4% of the global population. 4%! Yet its currency absolutely dominates international trade, global finance, and world reserves. Trillions, with a T, trillions of dollars move across the global financial system every single day. Governments depend on it, massive businesses trust it, and when global crises hit, people everywhere rush to get their hands on more dollars, not less.
So, the big question we're investigating today is, how did one country's money become the entire world's money? I mean, why does the global oil trade happen mostly in dollars? Why do foreign central banks just sit on mountains of US currency? Well, to figure that out, we actually have to take a step back and look at the very foundation of wealth itself. Which brings us to Section 1, the mystery of money, trust as the foundation of wealth. Now, the absolute core rule of wealth is this: money works because people believe other people will accept it tomorrow. It's not just printed paper, it is a system of absolute trust. You see, thousands of years ago, we relied on barter, right? Trading some wheat for meat. When that got way too inefficient, civilizations shifted to using rare, durable gold. But let's be real, lugging heavy gold around is pretty impractical. So, banks started issuing paper receipts. And people only accepted that paper because they fundamentally trusted they could swap it back for actual gold whenever they wanted. Without that rock-solid trust, a beautifully designed piece of currency is literally just a worthless scrap of paper.
Let's move on to Section 2. The rise of the dollar, from the British pound to Bretton Woods.
This timeline right here tracks a massive global power shift. Back in the 1800s, London was the undisputed financial capital of the world, and the British pound was king of global trade. But history has a way of changing through conflict. World War I completely devastated Europe. Meanwhile, untouched American factories were busy supplying the Allies, which ended up pulling enormous amounts of gold straight into the US. By the end of World War II, Europe was literally in ruins, but the American economy was booming as this arsenal of democracy. So in 1944, leaders from 44 Allied nations got together at the Mount Washington Hotel in Bretton Woods, New Hampshire. Their goal? To design a totally new international monetary system so the world wouldn't plunge into another Great Depression.
And it was at this 1944 Bretton Woods Agreement that the dollar was officially crowned. At the time, the US held roughly 2/3 of the entire world's official gold reserves. So they decided to tie the dollar directly to gold, specifically at $35 per ounce. This meant other nations could safely anchor their own currencies to the US dollar. You didn't need to hoard heavy gold bars anymore. You could just hold dollars, totally confident that they were, as the saying goes, as good as gold. This brilliant move instantly made the dollar the anchor of the global monetary system.
Now for Section 3. Surviving the gold standard, the Nixon shock, and the era of fiat money.
But you know, a good mystery always has a twist. By the late 1960s, this really dangerous imbalance started growing. The US was spending heavily on the Vietnam War, on domestic programs, and sending millions of dollars overseas. Other nations, particularly a very vocal France, started doing the math. They realized there were far more paper dollars circulating globally than America actually had gold in its vaults to back them up. So France started aggressively converting their dollars back into gold. This was draining US reserves fast and basically pushing the whole global system to the brink of collapse.
So to stop the bleeding, on August 15, 1971, President Richard Nixon goes on television and makes a historic move. He permanently severed the dollar's tie to gold, a huge event we now call the Nixon shock. Honestly, a lot of people predicted absolute disaster. But, surprise, global trade didn't stop. We simply entered the modern era of fiat money, currency with no intrinsic value, not redeemable for gold, Without gold, the currency holds value purely through sheer global trust in American institutions, the depth of its financial markets, and, well, the simple fact that everyone else was already using it.
Which brings us to Section 4, the petrodollar and the Fed, oil, interest rates, and global liquidity. Okay, so without gold backing it up, how on earth did the dollar stay on top? The answer emerged in the 1970s with what's called the petrodollar system. After the massive 1973 oil crisis, the U.S. and key oil exporting nations came up with a really brilliant pivot. They arranged for international oil sales to be priced and settled exclusively, and I mean exclusively, in U.S. dollars. Think about that. Because every single country on Earth needs energy to run its economy, suddenly every nation needed U.S. dollars just to keep their lights on and their cars running. A real game changer.
What this did was create a massive, continuous economic engine. It's a simple but incredibly effective three-step cycle. Step 1, countries buy oil using U.S. dollars. Step 2, those oil exporters receive tons of dollars, getting extremely rich in the process. And step 3, rather than just sitting on all that cash, the exporters recycle those dollars right back into U.S. financial markets, mostly by buying U.S. Treasury bonds. This continuous loop essentially cemented the dollar as the world's ultimate business currency.
Now add the U.S. Central Bank, the Federal Reserve, to this mix, and you really start to see the sheer scale of this power. Because the dollar sits right at the heart of global finance, a small group of bankers in Washington can adjust interest rates and immediately, literally immediately, ripple through the entire global financial system. They alter borrowing costs, stock markets, and economies from London to Mumbai. When the Fed raises rates, borrowing costs for any debt priced in dollars spike globally. And during crises like the 2008 financial crash, the Fed even steps in to supply emergency dollars to foreign central banks just to keep the world economy from going under.
All right, Section 5. Could the dollar fall? Challengers, network effects, and the future.
Look, history tells us no currency remains dominant forever, right? So could the almighty dollar actually lose its throne? To answer that, we first have to look at why central banks still hoard dollars today. Basically, it's their ultimate financial emergency fund. If a country's own currency crashes, they use their dollar reserves to stabilize exchange rates, pay for crucial imports like food and medicine during emergencies, and meet external debt obligations. They hold these reserves in U.S. Treasury securities because they are just completely unmatched in their safety and scale. You can buy or sell billions instantly without crashing the market.
Now, when we compare the US dollar to its biggest potential challenger, the Chinese yuan, we see a pretty stark contrast. Yes, China has had one of the fastest economic transformations in human history, and they are a massive global exporter. But despite all that economic size, strict capital controls in China prevent the yuan from easily taking over. International investors want to be able to move their money freely across borders. Right now, the U.S. Treasury market is vastly larger, deeper, and more liquid than China's current financial setup.
Then you have the euro, which faces a totally different hurdle. When it launched back in 1999, a lot of people thought it would rival the dollar. And while it is heavily used in trade and is the second most widely held reserve currency, it has a unique structural complexity. The Eurozone is made up of multiple sovereign nations, all with different political priorities and fiscal policies. That is very different from America's unified single government system. So during a severe global panic, that complexity makes the euro just a slightly less reliable safe haven than the dollar. However, and this is a big however, the case isn't completely closed. We are absolutely seeing gradual shifts that could reshape the future. For example, the BRICS nations, that's Brazil, Russia, India, China, and South Africa, are actively pursuing de-dollarization initiatives. They are trying to settle more of their bilateral trade in their own local currencies. At the same time, we're seeing the rapid rise of central bank digital currencies, or CBDCs. These are modernizing payment infrastructures and could potentially bypass traditional dollar-based banking networks altogether. But here's the absolute crucial point. The global financial system runs on dollars today because everyone else is already using dollars. It's called the network effect. It functions exactly like a global language.
Businesses use dollars because their customers use dollars. Banks offer dollar services because businesses demand them. It's this incredibly sticky, interconnected system where you use it simply because everybody else uses it. And that makes it incredibly hard to replace without some massive, highly coordinated global disruption.
As we wrap up this explainer, I want to leave you with a really provocative thought to chew on. Given the rapid shifts we're seeing in global technology, the rise of emerging markets, and changing geopolitics, will the US dollar still rule the world 50 years from now? Technology can definitely change how money moves, but at the end of the day, trust determines whether people actually want to hold it. Thank you so much for joining me on this deep dive into the forces shaping our global economy. Keep questioning, keep learning, and I'll catch you in the next explainer.